Hey everybody, it's Mike from Order Flows, and welcome to the Order Flow Blueprint, the Momentum and Reversal course. This is Module 1, Order Flow Out of Chaos. Now, the reason I made this course is to put an end to 95% of aspiring traders getting hopelessly lost along their trading journey. And this course is designed to teach advanced order flow to both beginners and advanced traders. And you're going to learn how to analyze market order flow on a scale never seen before by retail traders. Now, traders new to order flow are put off by the footprint because they think there's just too much going on. And that is because they don't know what they're looking at, which is basically volume and how it trades. Not only do you want to watch how large volume is transacting in the market, but also areas of lack of volume. And that is one of the drawbacks of looking at a book map or a heat map, is that traders are focused mostly on areas of heavy volume, not lack of volume. The footprint helps you see that lack of volume much more clearly. Order flow allows you to see what's been done and how it's being done at price. So how volume, both big and small, is trading at different prices is important. What other traders consider noise is critically important to order flow traders. And again, like I was saying, most traders focus on areas of heavy volume because, when you have heavy volume, that's going to create support or resistance in the market because, obviously, a market will stop at an area where there's strong buying or strong selling. And it's very easy to see, on a footprint, those areas, just as you can see them on a book map, right? You're going to see the big bubble up here. Okay, well, heavy volume. Okay, fine. That's just one part of it. What I'm asking you to do is turn the glass around and take a look at the market from a slightly different angle. You want to also start to focus on areas of lack of volume, because what lack of volume transmits to you is a market that is searching for liquidity. And if you're just focusing on areas of heavy volume, you're just leaving out a big piece of the puzzle, because when a market is searching for liquidity, that's a sign that momentum could be picking up, right? You're seeing these areas in the bars with very little counter trade, right? 0 against 38, 0 against 22, 8 against 15, 1 against 86, right? Here you got the volume here, 5, 1, 0, 2. This is a market that's searching for liquidity. And when a market is searching for liquidity, often that's a sign of momentum starting to pick up. So a problem many traders have is trying to make sense of a market that is acting illogically. And what I mean is when markets move opposite in the face of positive or negative economic data, right? They mistakenly think all good news creates moves up and all negative news creates moves down, right? But we know that's not the case, right? Sometimes the market, it just seems it has a mind of its own, and really sometimes, we've seen these numbers come out and the market act differently. So everyone has their own opinion of where a market should be valued at. Anyway, that's what makes the market, right, is the difference of opinion. Traders simply want an easy explanation for what happened, and unfortunately, they almost accept any reasonable explanation for why a market moved. Then the next time the same thing happens, they expect the market to act the same way. Okay, and that's what the point I'm trying to make is it doesn't, right? You got to be watching how the market is trading, what the liquidity is telling you in the market, right? Until a trader starts to understand for himself what makes a market move, which is the actual buying and selling taking place, they're never going to be able to progress. Now remember, right, in markets, there's only so much liquidity at certain times that you can trade against. There's going to be times of you sort of start with normal liquidity, then you have times of heavy liquidity and times of light liquidity. So you got to also keep that in mind, because sometimes, the markets move and they stop at areas of liquidity. They move very quickly through areas of lack of liquidity. That's why the markets spend a lot of time moving, is because they're looking for liquidity, right? You can see this bar here, right? People want to trade. We're coming up into the high. People want to trade. 858 contracts trade at this bar. Okay. You got a lot of traders coming in looking for an area they can trade at. And they're all competing with themselves, buying up whatever available offer there is, because in this case the market's going up. that they're sort of, imagine they're tripping over themselves trying to find volume they could trade against, and it doesn't come in until about 10 ticks higher up here. Okay, so sometimes it's also constrained by time or by the type of chart you're looking at, right? In terms of movement and liquidity, right? You can see this bar here earlier, right? 238 contracts trade, and you can see, it's kind of stretched out. You can see that the thin volumes inside as a trader is looking for liquidity that he can trade at, right? When it was trading 22, 23, there's not much liquidity there until he hits up here at 25 that he can trade against, right? And that's when big traders, they're constantly looking for liquidity because they're looking for an area where there's volume that they can transact against, right? People have this notion in their head that if there's like a big resting liquidity in the market, right, a big offer or a big bid, that the market's going to react to it. But a lot of times you see the market just trade right through it. Why? Is because a big trader has an opposite view and he has size to move, so he sees that size and he's attracted to it, right? So big resting liquidity doesn't act as a repellent all the time. Instead, it acts as an attractant. Now, all directional price movement is a result of an imbalance between traders who believe price is going up and traders who think price is going down. And therein lies the problem. We absolutely never know where prices are going to go. We all like to think that we can sort of predict where, the next movement is going to be. But what makes order flow so powerful is it really leaves the footprint, no pun intended, the order flow footprint chart, but it leaves this footprint of what is taking place in the market, where those imbalances are appearing. And just on a basic surface, knowing when the market is out of balance, right, in the sense of, okay, yeah, I can see selling imbalances coming up here at a swing high. I know there's aggressive sellers in the market. It's, this is what the beauty of order flow is giving you, right? A market that's going up, right? You're expecting to see the aggressive buying, and you have that. As the market starts going down, you have the aggressive selling, the selling imbalances in the bars. And, sometimes if you're just looking at a normal bar chart or a candlestick chart, you're not understanding that aggressiveness that's taking place. And then when you start to add in the volume that's there, not just on the imbalance, right? 153.47. When you start to see that, hey, you know what? There's very little counter trade coming in here, or in here, right? Then you get a sense of, not only do I have the aggressive selling coming in and the market's starting to move down, but I sort of have this lack of aggressive buying. And so, if you're expecting the market to move down and you have aggressive selling, also keep an eye on the aggressive buying. Is there aggressive buying taking place, right? Because obviously, for the imbalance, you're going to have more aggressive selling, for selling imbalance than aggressive buying. But if it's very light, very thin, zero, it's about as thin as you can get, that's a sign that's telling you, yeah, I got no aggressive buying here at this price, right? Normally you get some trades at every price level. And when you start getting, very thin volumes, zero, obviously, 1, 2, 3, 4, 5, then, that's a sign that you just don't have that aggressiveness coming into the market. So for every buyer, there's a seller. And another way to look at it is for every loser, there's a winner. And when somebody loses, there's a chance for you to make money if you're trading against them and realize they're wrong and exit their trade for a loss, right? That's where you can take advantage of the situation and, come out with a successful trade. So if you can determine where other traders are potentially making or taking losses, that's going to give you an edge. What if you can find those traders, right? Traders who are trading against the flow of the market are taking low probability trades. If the market is starting to show weakness in the direction of their trade, i.e. market going against them, they'll start to worry and stress out. And when the market finally starts to show signs of that, it's not going to move in their direction of the trade that they're in, they're going to get out, right? They're going to exit their losing trades. So you want to find those opportunities where other traders are taking losses. Okay, perfect example, right? Speaking of, liquidity, you see this market's coming down. It's searching for liquidity. It finds it down here below 107.12. And you can see, the 24, you can see 38, 30, 14, 11, 24. You see 96, 62, 17, 62, right? You've got 100, 120, so already 200. You got about 300 contracts being traded down here. Half the volume for this bar, more or less, a little bit less, maybe 45% of the volume for this bar is being traded down here on the bid side, right? It's 663. If you were to add this this volume up really quick, okay, let's just get a calculator. 24, 96, 62, 17, 62. So 261, right, divided by 663. So 39%, just slightly under 40% of the volume for this bar, right? That's the biggest bar on the chart, is appearing here at the bottom 4 price levels, right? Obviously, traders are stuck short in the hole, right? They're opposite of long and wrong. They're shorted down in here, and you see this market is stretching out. Now it's looking for that liquidity. It's going up, right? You see the imbalances, but more importantly, take a look at these lack of volume. All these zeros here, 3, 1, 2, 1, 0, 1, 4, 0. After you put in all that heavy volume at these 4 price levels, majority of the volume's on the offer side. So now people are realizing, they got short down in here, just, these last 4 price levels, and they're realizing the market's not going any lower, and they're looking to get out, okay? That's your sign that traders are stuck down here, right? And once you're able to recognize that these traders got short in here and they're wrong, that's your opportunity to take advantage of them and trade opposite them. Now, candlesticks have 4 parts, right? Obviously, the open, high, low, and close, right? Every bar has that same part. But, people that, trade candlesticks, they think it's got a little bit more mythical powers. I don't know. You are looking at the relationship to the open and the close, obviously. And yet it seems many traders put the importance on the close the most, right? It's the close that determines the type of candle you're analyzing. And the close is the most recent piece of data. Now, how order flow acts against the close of a bar is important in determining the movement of a market. All right, so, people sometimes ask me what's more important, the open or the close of the market. Obviously, the close is going to be the most important. And when you get on a bar-by-bar basis, the close of the bars, in my opinion, is, it's the last data point that's coming out of the bar. And when you're looking at a candlestick chart, right, in my opinion, you're just scratching the surface. It's one thing to see the way the candle forms. You've got your open, your high, your low, your close. And people like to sometimes read into it, well, we closed on the low of the bar. That means something. Yeah, sometimes it does. Let's say like, oh, you see this bar here? We opened on the high, closed on the low. It's bearish. Yeah, okay. Well, down here, we opened 1 tick off the high and closed on the low. Then the market reversed back up. So, with candlesticks, when they work, yeah, they look great. But if you're trading every sort of, candle that looks the exact same, and this is what I talk about, when people don't know why something happened in the market and they just look for a reason, then the next time that happens, they expect the market to react the same when it often doesn't. It's the same thing with the analysis, right? So you always got to take it in sort of context. Would I be looking to get short down here when, get the big red candle down? No, I find this one much more important. Now, if this was like a green candle, like this one here, where we say we open on the low, close up near a high, yeah, that'd be much more important, okay? But really, when you're looking at a candlestick, you're just scratching the surface. Really, the real power of the analysis comes in by looking at how the volume is being transacted inside the candle, so to speak, right? At the different price levels in the candle, okay? And, you could see just like here. Okay, yeah, you got your green candle. We open on the low, close on the top. Yeah, that's bullish, right? We got these buying imbalances. Yeah, that's good. And then you get up here. Okay, well, what's going on? You got a green candle. You go higher, you come off. You trade point of control up near the top of the candle. So it's telling you, majority of the volume is appearing up near the top. Okay, but now we're trading away from that. So what's telling you is liquidity was up here, but now the market's rejecting that area and it's starting to come off. And again, you're looking at a candlestick, right? That's up here. You're not getting that information. You're not see where the heavy volume is coming in. Most people say it's coming in on here. We came up here, looked for stops, came off. Well, actually, you came up here, you found value up here, right? It's trading heavy volume up here. It's not trading light volume. You didn't just get traded up really quick, 1, 2, 3 contracts. It's trading 30s, 32, 29, 50, 20, 20. So it's putting in that volume up there. Market starts drifting lower, comes back up. You have these two bars, one's green, one's red. They're the opposite of each other. Market came off. Well, why? Because we saw supply coming into the market. Right? You can see the volume, 33, 48. Right? Market started going back up. A big seller came in. Market came down. Next bar opened up, started trading up. A big seller came in. Right? You're not going to get that information here off of this candlestick. You're not going to see that. Oh, the reason the market came off is because there's heavy supply coming into the market. And there's supply coming into the market and the market's reacting to it. Yeah, to be short. So that's what I talk about, by adding the areas of volume into your chart in the sense of candlestick, order flow underneath the surface of the candlestick. It's just an eye opener. Okay. But remember, order flow is not an indicator at all. It's simply the market. It's data. I know people like to think that, order flow is the holy grail in the sense that you're going to know everything that's happening in the market, every single move so you could take advantage of, you get long here, you could short here. But really, it's just data, right? Once you know how to read it, yeah, then you can understand things a bit more clearer, right? You can understand that, yeah, I think based off, you could make those correct decisions, because most people would say, if you were just create an indicator, show me stacked buying imbalances. You got a big stacked buying imbalance here, you'd be looking to get long. Okay, but once you start understanding what's going on, these are the traders that are offsides, right? These are the guys that are long and wrong. They're looking for this market to keep going up. They're being very aggressive. Okay, you had some momentum coming in here. But what's happened is the market's rejecting these higher prices, right? And you can see, when you see a bar like this, right, you're not looking for the market to be coming off. You'll be looking for, the bar like here, where it's the big green bar up, not where it sort of just shoots up and comes back down. When you see that, and then you couple it with all the aggressive buying taking place, you got to be asking the question, what the heck is happening? Why isn't this market going higher? Well, the market's rejecting those higher prices, and you start to come off, start to circle back. Where were those higher prices coming in? That aggressive buying coming in? Right in here, right? We got within a couple of ticks back into that area, and then more supply came into the market, which sort of puts its cap on the market for the market to move down. Okay? Now, you hear a lot about indicators, and tools. Order flow data you can use to start creating indicators, because the beauty of order flow is that it takes into account volume. It not only takes into account volume, but how volume is being traded on the bid and the offer, right? So you could make those distinctions, of imbalances or lack of buying or lack of selling, or even the area in the bar with the most volume, right? The point of control. Now, when you start thinking of indicators, you often hear a lot about, lagging indicators, right? RSI, MACD. things like that. Okay, and order flow, again, is not an indicator, and it's definitely not a leading indicator. A leading indicator is one that tells you ahead of time where the market is likely to stop and turn. Okay, and so it's not making projections in that sense, because what you're doing with order flow is you're reading the information coming into the market, right? And then you're making a decision based off of that. You're not projecting it out in that sense. Now, retail traders have this thing in their head that they think they can look into the minds of institutional traders by using technical analysis or price-based indicators, right? But what retail traders don't understand is that institutional order flow is created from future fundamentals and risk management, right? Do you really think, a simple indicator, Bollinger Bands, MACD, can reveal what sophisticated hedge funds or institutional traders are doing? No, they can't. It's like, they'll throw a 200 EMA up or something. Aha, I've got it, right? You see how the market came right back up here, touched it, and came off, right? This is their big aha moment. Well, you could draw random lines, anything on a chart, and you're going to have an area where a market comes back to it, pretty much. I mean, it's just one of those things where it's coincidental. I don't want to say the market came back here because it hit a 200 EMA and then sold off, right? I mean, we hit the 200 EMA here and we just hugged it, and then we went higher, came down to it, and say, well, it rallied. Yeah, well, rallied 10 ticks, came off and just rotating around, then came off, and aha, this was the one, right? Forget about all this chop in here, all this garbage that took place. That doesn't matter. This was the one, right? But yeah, well, if you got short here, you took a loss. If you tried to get long here, it went up and you got stopped out here, you get short again. It's just a lot of nonsense, a lot of hoodoo. But when you look at the order flow, what's happening in here, you can see, well, there's liquidity coming into the market, right? That's your resistance. When you have liquidity coming into the market, that's what's offering a potential for a reversal, right? Because that's what you have forming here is a reversal. What you have is you have volume coming into the market, and I'll just go out on a limb and say it's not because the liquidity is not coming in here, because I know I've got a 200 EMA and we're coming up near to it, so everyone wants to sell it because, well, why didn't it react anywhere else? Okay. Really, all you got to do is just focus on this, the order flow, the volume, to understand why the market is reversing here, right? We know that markets reverse at areas of liquidity. Now, there's different types of indicators, right? There's leading indicators, lagging indicators. And what you also have is what's called coincidental indicators. And those are indicators that don't give useful information ahead of time. They may indicate when a market is trading up at support or down at resistance. It's sort of like an oscillator, but they don't tell you ahead of time, so they're not called leading indicators. Things like overbought, oversold, MACD, stochastics, they just put something out there on your chart, and they kind of lag the market, right? I mean, people, it kills me because I still see people, I'll say newer to trading, but younger kids, the younger generation, maybe I'm just getting old, but it's like they'll see this market big sell off here, and they'll say, wow, because you had this happen here in the MACD, and this in the RSI. Okay, that's just hindsight, okay? Because this was a nice move, yes, and there's a clear signal here, but what about all these other signals here, right? You have this MACD moving up, markets are just going sideways, okay? Stochastics, again, similar things. You're not getting much real information off of this, and the problem is this deals with price, and it deals with price to the left, the left of where it's trading right now. So it's putting a bit more weight on what happened in the past as opposed to what's happening right now. And that's what, the whole concept of lagging indicators, right? Lagging indicators wait for a move in price. then later give a signal to buy or sell based on that price movement. They lag behind current market activity, right? The signals are generated well after the fact and often generated, well after a move has taken place, okay? Price oscillator, okay? Yeah, I mean, it looks nice. You got this peak up here, corresponds to this peak here, and the market, sold off here. Okay, well, we're down here at 9:30. We're at the lowest low. Oh, starting to go up. Well, maybe I should get long. Well, what happens? The price goes lower. Okay, and it's a lot of that, right? Because it's based off of things that happened much earlier. Okay, and yeah, I mean, you will. There's a saying, right? Broken clock is right twice a day, and it's one thing to look at these moves, well after the fact and say, oh yeah, look at this. You could have sold it here, broke the zero line. That's how a lot of traders that use oscillators like to look at. They focus on the zero line. It's going down, but the market's going up. Okay, things like that. Here it's right. It's going up. What's happening in the market? Again, it's selling off. Eventually it went back up, but it's one of those things where you don't know the intensity of a move. If you're trying to look at, in some of these indicators, you don't know, how low it's going to go, right? From, up here to way down here. And this is, really a cherry-picked chart, whereas a lot of times it's just rotating around the zero line, even though the market's making a monster move. So, again, it's human nature to prefer lagging indicators because there's a certain amount of comfort in watching the market already moving in the direction of the signal. The problem is, how much further can the move go? How lagging is the indicator? And you don't know until the move is done. Now, a lot of software has a tool on there to find swings taking place in the market. And hey, you know what? Swing trading is great, right? If you can pull it off. Not everybody can pull it off. And it's one of these, like a NinjaTrader, they have the swing indicator. And you think, oh, this is perfect. I could just put this on and I'll just sell right here, buy right here, sell right here. And that's it. But if you've ever watched the indicator in real time, oftentimes it doesn't signal that the swing is taking place until the swing is already underway. And some swings are going to be bigger, like this one, than others, like this one. Because by the time this buy swing comes in, market's already up here. And you're getting long, and you're waiting for the market to move. But what's happening is it's already starting to calculate a potential reverse. Okay? And it's not going to draw this out until a certain amount of time has taken place. So by the time it recognizes that this is a bearish swing, it's already down here. You're below, obviously, you're underwater, and half the move's already happened. Okay, so bear that in mind, with certain indicators, because, the swing indicator, while it's useful sort of, in a longer context, when you're looking back at things, in real time, don't assume that you're going to just plot this on here and it's going to instantly pick the turning point here, right? As soon as this bar completes. Oh, no, it's not going to happen. Oftentimes, it may not even give you this bearish swing until, depending on what you set it at, if it's set at like 5, you really just got to go at least 5 bars. But by that time, the market's already starting to reverse, right? And you're going to get stopped out. So while potentially you could catch some big trades, you're also going to be getting stopped out quite a bit. Okay, so just bear that in mind, right? Swings take time to develop, and they look great in hindsight, but in fast forward to real time, you're not getting the signals as quickly as you think you are. Okay, so I mean, just go on there. You can see it here. If you're on NinjaTrader, go to swings and add it. And you could play around with it, but just bear that in mind, right? It's because it needs to go over a certain price. I mean, look at this. You got a buy signal here, and the market went down. Buy signal here, market went up. Okay, then you get the sell signal. You get your sell signal, market went back up and gave you a higher sell signal. So again, nothing is infallible. So if you're using a lagging indicator to determine a trend, by the time the indicator reveals a trend, the trend is often well underway and everyone else notices it. So just sort of going back, right? You can see some of these trends here, right? You can see the market go down, down, down. So maybe you're catching this trend, but by the time, if you're using the swing indicator from NinjaTrader rather, market's already trading down here. Half the swing is over. Okay, because you're running, you got a buy signal here to a sell signal. By the time the sell signal prints, you're often well below your buy signal, and the move is halfway over. And what order flow is going to allow you to do is see that reversal taking place here. Because again, looking back on, you throw the swing indicator up and it looks like it's picking every single turning point in the market, but it's not plotting it in real time in that sense of, oh yeah, we just pulled here and now it's starting to reverse up. Okay, it's going to draw. No, by the time it starts drawing this line out, the market's already moving away from that. So, again, with lagging indicators, maybe you can get in and get a little bit out of the trend, but then, that opposing trade comes in and the market retraces, stopping out traders that are using those lagging indicators because they got in late. And speaking of sort of lagging indicators, right? This is a different indicator. This is the psychological line. Big fancy name, psychological line. Market's going up, indicators going down. And that's the problem with lagging indicators is they're lagging. They don't coincide with what's actually taking place in the market, right? You should be expecting the indicator to be going up, but it's basing its decision off of stuff happening previously. That's why what's happening right now is not being taken into account until it's already happened. Do you understand that? That's what we talk about, with the order flow. You're using the most current data, right? The most current information. You're not using information from 10 minutes ago. You're using information from right now. Now, many traders try to confirm their analysis by combining indicators for confirmation. However, the problem is that they use indicators that are often similar in nature, or the parameters that are highly correlated. Right? For example, using a 21 EMA together with the Bollinger Band that is based on a 20-day, simple moving average. I mean, what's the point of using things that are so correlated? They're using basically the combination is the same. Basically, you can see this blue line is the EMA. This black line or dark gray line in the middle is the 20 Bollinger. And basically, it's got the exact same price movement. There's not much difference between the two. I mean, obviously, the Bollinger Bands has the upper band and the lower band, but it's basically giving you the same information. You can do the one standard deviation of a 20 EMA, and it'll give you the same sort of band probably. So, again, if you're going to use a method of confirmation, don't use things that are so correlated that essentially you're using the same indicator. And that's where order flow makes that difference, because now you're not just trying to manipulate price, take price and bend it, twist it into something else. You're using the added piece of volume, all right? How the volume, not only just volume, like that's not saying, 200 contracts traded. No, it's saying 20 contracts traded on the bid, 180 traded on the offer. So that's going to give you an extra layer of information based off what's trading right now. Not a 21 EMA, taking price from 20 bars ago, 18 bars ago. You're making your decisions based off what trading is doing right now. Now, the bottom-up method, right? You always hear the top-down method, right? And who was it? James Dalton or Stoudemire, I think, are the ones, someone of those two coined the term the top-down method. But I hear it with every trader out there on YouTube and everybody. I start with the top-down method. I look at the monthly chart. I look at the weekly chart. And I look at the daily chart. Yeah, I don't think people do that as much as they say they do. But the bottom-up method is all about starting with the most basic concepts and working your way up while identifying the critical elements that make each of the situations ahead unique and knowing which factors to consider in each one. And sort of my goal, what I like to do with traders, is turn your brain into an order flow processing computer that efficiently considers only those factors of order flow that's most relevant to current market conditions right now. Basically, you got to trade in the now, okay? And it's just one of those things that not a lot of traders, I don't want to say understand, but really wrap their head around, okay? And again, the bottom-up method, okay, is sort of runs contrary to the top-down method, because with the bottom-up method, you are really literally taking what's happening right now. You're not starting out a month ago on your analysis or a monthly chart or a weekly chart. You're basing your information off of, okay, well, what's the aggressive traders doing? What's point of control doing? What's imbalances doing? Coming down into a low, I see, yeah, okay, we're coming down, negative delta, negative delta. Now, off the low, starting to rally up. Point of control is higher, 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 higher. Delta is positive, more positive, more positive. That's a good sign. Start looking at the max delta, the min delta, strong max delta, so I know we got some nice strong aggressive buying. Very little min delta, so aggressive sellers not that strong. Doesn't mean that there's no aggressive selling, because obviously we got people selling into the bids in these bars. But when I see the max delta, obviously closing up near, or the final delta closing up near the max delta, is telling me, it's quite strong. And obviously, just looking at the volumes in the bar, what's taking place, a lot of the volume is coming in on the offer side. Obviously, you got the positive delta, simple look at things like the volume on the bid side. Right here, the 525 stands out. It's some heavy volume coming in. So I know there's some supportive buying coming in as the market is moving up. So basically, the bottom-up method, you're looking at what's happening right now and making your decisions based off of what's happening right now. You're putting the pieces of order flow together. Now, something I want to talk about is sort of, I saw this a quote about the law of flotation. And the law of flotation was not discovered by contemplating the sinking of things, but by contemplating the floating of things, which floated naturally, and then intelligently asking why they did so. It was this guy, Thomas Troward, that made that quote. And in the markets, it's the same thing. Asking why the market acted the way it did is going to help you understand it, right? Rather than, going back, earlier I had talked about traders always looking for an easy answer. Well, the market sold off because, Putin. Let me just take a step back. I don't know, maybe some of you guys are too young to remember, but gosh, back in the 90s, the markets, there was a time where Bush Sr. was eating sushi and he was like choking on the sushi, and the markets reacted to it a certain way. And, in the old days, before the advent of the internet, right, we're now, information travels super fast. Rather than sit there, try and scroll through Twitter looking for the easy answer why, Bush ate some bad sushi or something, just simply follow the order flow. Look at what is happening and why it happened, and you're going to understand why a market is moving a certain way, right? You can see the aggressive selling coming in here. Market found liquidity as we're making these lows. 169 traded here, 74, 160, 102. You can see that heavy volume coming down. Now you're starting to see the market is looking for volume on the upside. You're seeing lack of two-way action here, right? 0, 1, 5, 0. And I want to get into this in the momentum, right? This is a sign of buying momentum coming into the market. But, that's in a later module. So I'm just sort of touching on it here. But really what you're starting to see, and that's why I'm making this course on momentum, is because momentum sometimes is so easy to spot. You talk about being able to identify, which direction the market's going to move. When you understand what momentum looks like in the order flow, it's going to give you some nice trade opportunities. And this is a sign of bullish momentum, more bullish momentum here. Okay. And when you see that bullish momentum coming in, there's only one way to trade it. You got to be bullish. Okay. And since it's very visual, if the market starts trading opposite, then you're going to know that the bullish momentum died. Okay, that is over. Time for you to get out of the position. But it sort of goes back to understanding, where traders are wrong. All these aggressive sellers that were in here, how many hundreds in here, how many hundreds down here are wrong. They got to start getting out. Okay, you got that strong selling. You're looking for this market to continue going down. It's not. All these aggressive sellers are wrong. They're losing money. Markets starts trading up. It's not even coming down. You got 1 bar, 2 bars, 3 bars, 4 bars. Then you got that bullish momentum again coming in here. It's had 5 minutes. This is a 1 minute chart. It had 5 minutes to go down, go lower, to join all these people that were short in here. Instead, it's nowhere near that area. It's going up. You got that bullish momentum coming in. And, that's what makes some of the best reversals, is when you have the strong move down, then you're starting to get the move up, right? You're starting to get the bullish momentum. That's where reversal trading is going to give you some great trading opportunities, right? Because you're going to know that if it breaks this area, breaks a level, it's wrong. You don't need to set really wide stops out there. So before you start to wonder what the market will do next, understand what the market just did. Okay? And that's about seeing where buying and selling come in, but more importantly, it's about watching how the markets react to that buying and selling. All right? Market's coming in hot. It's coming in strong here. MNQ coming down, aggressive selling. It found its area of liquidity down here. It found its volume. When it finds the volume, it will often reverse. Okay, and that's what you see. And then you see the aggressive buying coming in, just like on that previous chart I just skipped over really quick. This was gold again. You got that strong aggressive selling coming down. It found some liquidity down here. It found an area, and not just in this 1 bar. You got to start looking at it from, the bars surrounding it, right? As it's forming, right? As it's coming down, you say, okay, yeah, I got some heavy volumes here. Now we're sort of spinning around, putting in some more heavy volume. Then we jump up here. Where's the counter trade? Where's the trade in here? This market's moving away very fast. You can see 2, 0, 1, 1, 0, 8, 1, 2. Then that aggressive buying coming in. Similar thing in this bar, right, with the volume wise. So you know that you put in some liquidity here. You know the market's not interested in testing that liquidity again. This one is a bit more obvious. It's a nice V-shaped reversal very quickly, very dramatically going up. So pay attention when the big traders are trading aggressively, taking liquidity, or whether they're trading passively, providing liquidity. Right? You can see on this move down, big traders are providing liquidity, meaning there's passive offers coming in as the market's going down. We know that that's bearish, right? Just as, where was it here? This market going up, we know there's big traders providing liquidity. How do I know that? It's the heaviest volume is here, 525, as this market is going up. Okay, just as here, market's going down, big liquidity, 44 here, 102, 58, 59. Right? That's why this bar's got positive delta. Because there's liquidity coming in here. Even here, it's not an imbalance, but you got 45 here, a couple 25s. So there's liquidity coming in. You have big traders coming in, providing liquidity. It's not just about seeing where the big traders are taking place aggressively, because if you were doing that, you say, well, I got a buying imbalance here. This market should be going up, but it's not. Why? Yeah, you have aggressive buyers buying it here, but what you have is the market going down. People are providing liquidity on a market that's going down is a bearish sign. So once a trader is able to trade based on the buying and selling taking place in the market instead of outside factors, it's almost an epiphany, right? It's like, oh, it changes their mindset. The market doesn't care what your opinion is, and Shoei doesn't care what your opinion is. And so it's the same thing. I had to alter that. But, the market is going to move regardless. Right? The market doesn't care if you make a profit or a loss on your trade. The markets don't care where your 1 lot stop is, your 5 lot stop in MES is. Your ability to trade dwells in you. It's in your ability to make sense out of all the nonsense that's taking place. Remember, trade off of what's happening right now in the market. If you can see big traders coming in, providing liquidity after a move takes place, right? We just made a new low here. Now we're getting big traders coming in, providing liquidity as the market starts going up. Yeah, you're going to want to position yourself going in that direction. But again, it doesn't mean that it's going to hit this low and it's just going to go straight up the rest of the day, because with trading in the now. Because remember, if you're using some sort of price-based indicator, that's looking at bars from 10 bars ago, 20 bars ago, maybe you see something bullish taking place in here, but it's giving you your bullish sign here before the market sells off. But if you're looking at the order flow, as it's taking place, you could see, oh, okay, there's some bearish liquidity coming in here. You could see some bearish momentum taking place here. Definitely bearish momentum taking place here. It's just market's just getting swept right through these levels. 0.00001. All right, you see volume is migrating lower in the points of control. So if you're using something that's really lagging, is probably giving you a buy signal here instead of a sell signal. And what happens? The market makes a new lower low. So you may not realize it, but how you approach learning order flow is one of the biggest factors in determining your trading success. So instead of being stuck spinning your wheels going nowhere, you can motivate yourself and become more excited to becoming the best trader you can be. So this concludes Module 1. I'll see you in the next module.